Hello and welcome to Wall Street Vision, a show that explores investment ideas from the best investors in history. I'm your host, Vlad. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. I may maintain positions in the securities discussed on this podcast. What's up, Vision Nation? I hope you've had a nice weekend and that you're keeping healthy and well. In this week's episode, we're going to cover how Jim Sinegal made Costco a powerhouse of a company using a business model called Scale Economics Shared. If you haven't heard of Scale Economics Shared, it's a pretty new concept. It's pretty much a business model on steroids, and it's given amazing results to companies that have used it. We'll go over this concept and why it's so powerful. Let's dive right in with a story about Jim Sinegal and Costco. So Jim is the co-founder of Costco. He came from really humble beginnings. His dad was a steel worker and coal miner. That alone tells you the kind of childhood Jim went through. I mean, if your dad's a coal miner, there's not too much complaining you can do if you don't feel like doing your math homework. Jim started his working career in a warehouse unloading mattresses. He also worked bagging groceries while earning his bachelor's degree. So this guy had a real middle-class upbringing. He's not one of these CEOs whose parents started them off with a trust fund. He spent a bunch of years working in different retail companies and he rose up through the ranks. Then one day, he gets a call from this lawyer. The lawyer cold called Jim out of the blue. The lawyer wanted to start a company in the wholesale retail space, and he was looking for a partner. Jim was at the ripe age of 46 when they started Costco together. Costco didn't instantly take off, but their sales increased over time and they gradually opened more and more stores. For my international listeners that don't have a Costco in their neighborhood, the main concept of Costco is it's a big warehouse store, kind of like a Walmart. But in order to shop at Costco, you need to have a membership card. A yearly membership is about $60 or $120 depending on what type of membership you have. The model that Jim used at Costco was to sell products as cheap as possible. The margins they had on products were smaller than grocery store margins, and grocery store margins are tiny, they're like 2 to 3%. Jim kind of had this rule where he would not allow Costco stores to mark up prices of products by more than a certain amount. This was the case even for products that the store could sell for a lot higher. Jim's rule was to keep prices as low as possible to keep customers happy. The crazy thing is that he did this even when he could sell for higher prices. Their whole philosophy was to provide amazing value to their customers. Their business model was to sell lots of volume in product and make money off of the membership cards. The memberships were great because they provided a solid source of revenue for the company and they didn't really cost Costco that much money to maintain. So some of the things they did to keep prices really low was they kept the stores really basic with lots of products for sale just sitting on wood pallets instead of having fancy presentations. Jim also kept inventory low and did no advertising. And the reason to keep inventory lower is it allowed Costco to focus more on buying fewer products. But the products chosen would be just the right type of product that people would actually want to buy. They also launched their own Kirkland brand. Kirkland is Costco's own personal brand that you can only buy in Costco stores. That brand covers a ton of items, so you can get anything from Kirkland. You can go from buying Kirkland socks to buying Kirkland vodka. By the way, funny enough, there were a bunch of blind taste tests where Kirkland vodka beat Grey Goose vodka. And Kirkland vodka is only a third of the price of Grey Goose. I can imagine that the PR team for Grey Goose was not too pleased to hear about that when it happened. And actually what ended up happening is people online started a rumor that Grey Goose secretly made Kirkland vodka and sold it to Costco. Now, Grey Goose denied that that was the case, and Costco didn't comment on it, so the jury's still out on that one. That just tells you that Kirkland is not some terrible quality brand. They make really high quality products and sell them for amazing prices. Now, let's go back to Jim. As CEO, he was known for traveling to each store location every single year. He wanted to inspect them personally. I bet that kept people on their toes a lot. If the CEO was coming to visit regularly, he'd make sure that everything was up to par. I kind of know what that feels like. When I went to college, I worked in this Middle Eastern restaurant as a server. Well, the founder of the restaurant would make it a point to randomly pop in for visits. And let me tell you, that made all the staff go the extra mile to make sure the restaurant was always clean and the customers were always happy. In Jim Sinegal's example, it's kind of funny to think of the top guy in the company flying in a private corporate jet to Kalamazoo to check out their store in person. And yes, Costco actually does have a store in Kalamazoo. I just Googled it. So you can already tell that Jim wasn't the type of CEO who would sit in his ivory tower without knowing what was happening on the ground floor. Another thing that made him stand apart from the rest of the CEOs out there was that he earned a salary that was only a third of what a typical CEO would earn. He was making around $350,000 at the time, and the typical CEO for a comparable company would be making about $1 million. Jim's office was not fancy at all. He used this cluttered room without a door, and it literally had folding chairs as furniture. He also didn't have a secretary, and he answered his own phone. From a culture perspective, Jim was a very honest, hardworking person. There's a story out there that Costco once promised to pay 90% of employee healthcare expenses, and one day Jim found out that they had only paid 88%. Well, he apologized for that oversight, and he reimbursed the employees the extra 2% and paid it directly into their retirement accounts so that they wouldn't get taxed on that. So all of the stuff that Jim did really made sure that Costco had some of the lowest turnover of employees in retail. The fundamental reason is that they treated their employees extremely well. Not only did the workers get paid a lot more than they would have in another comparable retail place, but they also got health benefits, which was super rare in retail at the time. They also promoted almost exclusively within the company. So there's a bunch of stories out there of people starting out pushing shopping carts in the parking lot and ending up being vice presidents in the company. How awesome is that? Compare that to many companies you hear about these days where most of the top senior people are hired from outside. Jim's philosophy was that if the employees were happy, they'd treat customers well, and he wanted these brand ambassadors making the customer shopping experience as good as possible. Jim went out of his way to treat employees way, way, way better than the average retail store. That makes a ton of sense. It reminds me of an experience I had at a store 2 years ago. I went to this name brand store where the employee was being really snarky. I don't blame him too much. The guy at the store was mentally checked out, and I could tell that he didn't want to be there. Now, I've got nothing against the guy, but you know what? It did really leave a sour taste in my mouth. So I won't go back to that store if I can avoid it. And that happened over 2 years ago. That's the type of thing Jim Sinegal did not want to have at Costco. He wanted engaged employees that treated their job with respect. And Jim would say that's not something that he just did to be a good person, but it also made for good business. Now, Costco did have some bumps along the way, but by the time Jim retired in 2012, Costco grew to over 600 stores. So going from 1 store to 600 stores in the time that he was CEO. That also translated to a big growth in memberships, which allowed Costco to negotiate with suppliers. In 2012, they had over 30 million members, so that gave them a lot of negotiating power. As an example, when you go to a chicken supplier to negotiate prices and you tell them you have 600 stores and 30 million paying members, they're going to be willing to sell you chicken at a low price because they know that they're still going to make a profit on a high volume. Jim wasn't poor when he joined Costco, but to have his net worth balloon up to being over $100 million by the time he retired is nice to see for such an honest, hardworking person. He also started a family foundation, and he's donated tons of money to fund scholarships. He retired in 2012. So what did Jim Sinegal do to make Costco such a huge success? One of the big drivers of Costco's success during the Jim Sinegal years can be explained by a concept called scale economics shared. Before I get into this concept, I want to give credit to Nick Sleep for making this concept popular. Nick Sleep was a great investor that had annualized returns over 20% per year for around 15 years or so. 20% is Warren Buffett's annualized return as well, so you know Nick Sleep had really good performance. Anyway, back to scale economics shared. To understand this concept, let's start with economies of scale. Economies of scale is a fancy way of saying that the more products you produce, the lower the average cost per product. If you picture a large factory making widgets, the cost of each individual widget is going to be small because the company can make so many of them. Economies of scale can happen in different industries, but the gist of it is that big companies have advantages that can get their costs down for each individual product that they create. Okay, that's fair enough. So what are scale economics shared? When a business becomes bigger and gets lower costs for each individual product that it makes, it can do two things. The business can either keep the extra profits or share some of the profits with its customers. As an example, the business can pass on savings to its customers by lowering prices. So what happens when customers get lower prices? When they pay lower prices, customers are happy, and that increases the chances that they'll keep buying from that same business. Loyal customers create a strong moat for the business, so it keeps competitors away. Competitors stay away because of the loyal customers and because the profit margins remain small, so it's not tempting for them to compete with the original business. This creates the cycle where sharing profits with the customers helps the business grow even more. So let's go back to our Costco example. What are some of the things that Jim Sinegal specifically did to make scale economics shared work? He paid his employees really well and gave them great health benefits. He made a point to limit how much each store could mark up their own products, essentially selling all their products at cost to the customers. Doing those two things made his employees happy, and it also made his customers love the store. As Costco grew and they were able to get volume discounts from suppliers, they still passed on those savings to the customers. And really that meant that the bigger Costco got, the harder it got for other competitors to come in and compete with Costco. Why is this different from what some of the other businesses out there are doing? Jim had a different philosophy than the philosophy that a lot of other CEOs have out there. The more the company grew, the more he kept reinvesting into the business. Some other CEOs out there would take that growth and start raising prices on their products to increase earnings and keep Wall Street analysts happy. I want to mention that analysts didn't really like Jim because he wasn't focused on increasing margins to make more money off the customers. If he increased margins, he would have temporarily boosted Costco's stock price, but he was a long-term thinker, and instead of focusing on the next quarter, he would focus on the next decade. So why is scale economics shared such a powerful business model? It's powerful because if a business does this successfully, it can create a long runway for the business. In episode 14 of the podcast, we talked about stocks that give you a 100x return. One of the key things for these types of stocks is having a long runway where competitors can't steal market share from the business. If you look at statistics, businesses today last a lot less than businesses lasted 50 years ago. As an investor, if you want to invest in a business for a period of 15 years, you want to make sure that the business model is rock solid. You don't want to invest in MySpace when Facebook is going to come in and provide a better product. So scale economics shared is powerful because a business that does this well is very hard to compete with. Nick Sleep says that this is a concept that is durable. If a company uses scale economics shared well, it can grow for a long time, and it's going to be really hard for other companies to compete. He also talks about how in investing, most of the information that you get has a limited shelf life. Kind of like food, it goes bad quickly. For example, if you know the quarterly earnings of a company, by next quarter, that information is not as useful anymore. So Nick's recommendation is for investors to focus on information that has a long shelf life. If you understand that a business has the advantages of scale economics shared, that's a piece of information that's going to have a long shelf life, which means you can predict the future for that type of company with better odds. I want to mention that I took the ideas in this episode from a bunch of different sources. You can check them out in the show notes. Alright, Vision Nation, that wraps it up for this week's episode. If you've enjoyed it, please hit the subscribe button, and if you know someone who's interested in investing, please share this episode with them. Thank you so much for listening, and I hope you have a great day.